Okay, so let's start. We want to start this new topic. And our topic for today is called financial instruments. We want to start this topic called financial instruments. We finished the topic of cash flow. Now we want to start the topic of financial instruments. So let me introduce it. Okay? Now, let us assume that you are a company. And as a company, you want to raise finances. I want to take you as a company called A Limited. You are a company called A Limited. You want to raise finances for your company. There are various ways in which you can raise finances. One way is to issue shares. You can issue shares to the public. Another way is to issue debentures. Another way is to issue bonds. Okay, so those are various ways in which a company can raise finances. Now, it is obvious as a company A who is raising finances, another company, another individual or another company, let's call it company B. Let's call them company B. Just a minute. Let's call them company B. Company B now will come and buy. Company B, just a minute. Company B now, let's continue now. Company B now will come and buy either your shares, either your debentures, or the bonds. So I'm saying you are a company A trying to raise finances. You are trying to issue shares or issuing debentures or issuing bonds. Another company or another individual, we want to call it B, will be the one to come and buy your shares or buy your debentures. Now, from the point of view of financial instruments, we normally refer to company A as the borrower. They are the ones who are borrowing finances. Company B or individual B, we normally refer to them as the lenders or the investors. We refer to them as the lender or the investors. Now, so a financial instrument, these instruments you are issuing, the shares, the debentures, and the bonds, those are what we are calling a financial instrument. So how can we define a financial instrument? Listen, before I define it, look at it this way. I have said you as company A, you are borrowing finances. If you are borrowing by issuing shares, listen, that will create in you what we call equity capital. It is obvious when a company issues shares, they are having or to raise what we call equity capital. If company A raises finances by issuing bonds or debentures, that will create in them what we call a financial liability. It will create in them a financial liability. Look at the lender now, or the investor. Whether the investor buys shares, whether he buys bonds, whether he buys your debentures, to the investors, this financial instrument will create what we call a financial asset. To them, it's a financial asset. When they buy shares in company A, in the books of B, they would have an account called investment in shares of A. If they buy their bonds, they would have an account called investment in bonds of A Limited. So to the investor, he will look at this instrument like an asset. While to the borrower, this financial instrument is either equity capital or a financial liability. So we normally define, now listen, we normally define a financial instrument as a contract that leads to a financial asset to one party. It's a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. Then we have agreed to the lenders. Financial instruments create financial assets. To the borrower, financial instruments create either equity capital or financial liabilities. That is it. So that's how we deal, or we value, that's how we define financial instrument. That it's a contract that leads to a financial asset to one party and a financial liability to another party, or a financial asset. Good. Now, before we continue, listen carefully. For some of you, you are joining us for the first time. For some of you, you are joining us for the first time. Listen. For some of you, you are joining us for the first time. Listen carefully. There are times when the internet on your side may be low, and therefore you are disconnected. Get the point? Especially for those who are new, today is a free lesson. But for my normal students, listen, for my normal students, it's a continuation of the syllabus. But I thought I'd give it as a free lesson to everybody for now. But my normal students know this. Listen, I am talking to the new students. Sometimes you may be disconnected because of the Wi-Fi strength on your side. If you are disconnected, to come back to the class, don't click on the disconnected video. It will not take you back. What you can do, listen, what you can do is two things. One, you can refresh the page. If you are using a laptop, of course, on the left side of the laptop, you normally have that something for refreshing the page. That something looks like this. That is the one for refreshing the page. If you are disconnected, if you are using a phone, I think it's on the right corner. For laptops, it's normally on the left, that refresh button. And for phones, I think it's on the right corner, top right corner. That's one way. If you are disconnected, you refresh the page. I hope I'm communicating. The alternative way is to go back to the link that you received and click it again. I hope I'm communicating. The second way is to go back to the link that you received and click it again. It will take you back to class. So there are some students who sometimes say that they have been disconnected, they cannot reconnect, they can't connect. So we are saying, once you are disconnected, there are two ways to come back to class. Because sometimes your Wi-Fi may be weak. So one way is to refresh the page. Refresh the page using that refresh button. The second way is to go back and click on the link again. Don't click on the video. It sometimes refuses to take you back to class. But when you refresh the page or you click on the link again, it will take you back. It will take you back to the class. Good. Sawa. So let's continue now. So I wanted us now to put down a summary note. I wanted us to put down a summary note of what we have already said. A summary note of what we have already said. So let's put down the notes for my normal students. For the others, you don't have to put down. For the others, you don't have to put down. Today being a free class. But for my students, this is part of your notes. Put down this. The topic is financial instruments. The topic is financial instruments. Then you say this. A financial instrument is a contract. A financial instrument is a contract that leads to a financial asset to one party. Financial instrument is a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. So we are saying a financial instrument is a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. Another paragraph. To the lenders or investors, a financial instrument creates. To the lenders or investors, a financial instrument creates a financial asset. Creates a financial asset. While to the borrower, a financial instrument creates. While to the borrower, a financial instrument creates either a financial liability, or equity capital. Creates either a financial liability or equity capital. Good. Now we are through with what they are. What is a financial instrument? Now we want to go further. And discuss how do we recognize financial instrument? In other words, how do we measure financial instruments? So let me discuss it first. Let me discuss. So what we are saying is what I want to discuss is what we call recognition and measurement. Recognition and measurement of financial instruments. Let me discuss it first. All financial instruments, all of them, whether it's a financial asset, whether it's a financial liability, all financial instruments, whether to the borrower, whether to the lender, the point is, on initial recognition, all financial instruments on initial recognition, they should be valued. All financial instruments should be valued at their fair values. That's how they are initially measured or recognized. All financial instruments should initially be measured at their fair values. But at the end of each year, in other words, subsequently after that, how do we measure those financial instruments? Now, how to remeasure the financial instruments at the end of the year now will depend on whether you are dealing with a financial asset or are you dealing with a financial liability. I have said, initially, all of them are measured at fair value. Subsequent measurement depends on the classification of the financial instrument. In other words, is it a financial asset or is it a financial liability? Or is it a financial liability? If your instrument is a financial asset, then again, that financial asset can be measured in three ways. That financial asset can be measured in three ways at the end of the year. One, it can be measured at fair value. At fair value. Now, maybe I can start with the other one. Let me start. It can be measured at what we call amortized cost. It can be measured at amortized cost. We shall talk about when is it measured at amortized cost. Or it can be measured at fair value. It can be measured at fair value. At fair value through what we call other comprehensive income. At the end of the year, you can also measure that financial asset at fair value through OCI, or what we call other comprehensive income. Meaning this, don't forget, initially you measured it at fair value. If at the end of the year, again, you are measuring it at fair value, let us assume that by the beginning of the year, that financial instrument had a fair value of 2 million. By the end of the year, it has a fair value of 2.5 million. That change of 500,000, now take it to the other comprehensive incomes. Of course, you have done published accounts. And when you have done published accounts, you know, after you are through with your normal income statement, then you may be required to show a section we call other comprehensive incomes. So when sometimes you used to be told in published accounts that you prepare a statement of comprehensive income, it meant that you had to show the normal income statement. After you are through with the normal income statement, now you bring in other comprehensive incomes. You know, examples of other comprehensive incomes used to use in published accounts include gain on revaluation, whatever it is, of fixed asset. Now we can bring in another one, that here is a financial asset which was valued at 2 million. By the end of the year, it has a value of 2.5. There is a gain of 500. That gain could be taken to that section called other comprehensive income. That's another way. So that's another way you can measure the financial asset. The third way in which you can measure financial asset, again, is what we call at fair value through P&L. At fair value through P&L. Meaning again, here could be a financial asset which initially had a value of 2 million. Come the end of the year, it had a value of 2.5 million. That change in fair value of 500, you take it to the profit and loss. We shall discuss which kind of financial assets are these. Who's that 500, I take it to the P&L account. Which financial assets are these? Who's that 500, I take it through other comprehensive income. That's what we shall discuss. So for financial asset, I have said, In summary, we have said all financial instruments should initially be measured at their fair values. Subsequent measurement depends on the classification of the financial instrument. That is, whether it is a financial asset or it is a financial liability. I have said, if it's a financial asset, there are three ways in which those financial assets can be remeasured, either at amortized cost or at fair value through OCI or at fair value through the profit and loss. So let me go through and discuss how do we know which kind of financial assets should be measured at amortized cost, which are these financial assets that should be measured at fair value through OCI, and which kind of these financial assets are the ones that should be measured through at fair value through P&L account, at fair value through P&L. So let me go through those financial assets first. Then I'll talk about the financial liability. Good. So let me start with the financial asset. Don't write this. I want to use a table here just to illustrate how. We have said financial assets can be measured in three ways. Financial assets can be measured in three ways. One, at amortized cost. Two, at fair value through OCI. 3, at fair value through P&L. Through P&L. Good. So now listen, because this is where now the issue is. This is where now the issue is. Now listen. What are the characteristics should this asset have for it to be measured at amortized cost? What is this nature of an asset that should be measured at fair value through OCI? Good. Now, let us assume, I'm going back, let us assume this company A was issuing, I want to start with that the company A was issuing a 10% bond. A 10% bond whose nominal value is 200 million. Let's call it Kenya Power. Through their stock market, they issued a 10% bond, or Centum, or Safaricom, or BAT. They want to raise funds, and they issued a 10% bond worth 200 million. Now listen, as an investor, you bought it. As an investor, you bought it. Maybe this bond will mature after 5 years. This bond will mature after 5 years. That means it will be redeemed after 5 years. Listen carefully. As an investor, you are holding this instrument with an objective of collecting what we call contractual cash flows. Contractual cash flows. Get the point? It is automatic. As an investor, I know every year I'll be paid 10% of 200 million. 10% of 200 million, which is obviously 20 million every year. That 20 million every year is my cash interest that I'm receiving. The cash interest received. Then after 5 years, the company will redeem that bond and I'll be paid back my 200 million. When I buy this bond today, I am buying it and holding it with an objective of collecting those contractual cash flows. Number 2, those cash payments that I'm receiving, they are for payment of interest, the 20, and the payment of principal. Good. Now listen. If you have such an instrument, you as an investor, remember it's an asset to you. You have that kind of an instrument, and number 1, you are holding it with an objective of collecting contractual cash flows. That's number 1. Number 2, those cash payments are for payment, or those cash flows are for payment of principal and interest. Then that kind of financial asset should be measured at its amortized cost. So the 2 conditions I'm giving for an asset to be measured at amortized cost, these are the conditions. We have said 1, this instrument is held to collect contractual cash flows. We are saying this instrument is held to collect contractual cash flows. That's 1. That as an investor, you are holding this instrument to collect the contractual cash flows. Number 2, you are holding this instrument, and those cash flows are for payment of interest and principal. So when your instrument has those 2 characteristics, then that instrument should be measured. That instrument should be measured at its amortized cost. At its amortized cost. We have not discussed how to determine the amortized cost, not yet. But just know that these are the kind of assets that should be measured at amortized cost. Those assets that you as an investor, you are holding with an objective of collecting contractual cash flows. Contractuals in the sense that it's guaranteed. Every year 20,000, 20 million, 20 million, 20 million is what I'll be getting as cash interest. 5 years later or 10 years later, whichever the year of redemption, I'll be paid back my principal. That is what we are calling contractual cash flows. You know. Number 2, those cash flows, they should be for payment of interest and principal. That is it. Now we go to the second category of cash flows, of assets that should be measured at fair value through OCI. Listen now. Under this category of those that should be measured at fair value through OCI, we have 2 subcategories there. One, it is for what we call debt instrument. Debt instrument. Let me rub it so that it becomes clear. That means as an investor, you have an investment which is of a debt instrument in nature. Alternatively, it could be one that is for what we can call equity instrument. Equity instrument. Let me explain. Debt instrument is like the debenture. When you buy the debenture or you buy a bond, you as an investor, you are buying a debt instrument. When you buy shares of company A, you are buying an equity instrument. Okay? Now listen. So we are saying, we are looking for those assets that you as an investor, you should measure them again at fair value by the end of the year, but the change in fair value should go through the OCI. Which kind of financial assets are these? Number one, if they are financial assets which are debt in nature, debt instrument in nature, then listen now, then they should have the following, characteristics. For an instrument to be measured at fair value through OCI and it is a debt instrument, it should have the following two characteristics. That means we are looking at the conditions. One, again, listen, again, you as an investor, you are holding this instrument. Listen, you are holding this instrument to collect, listen, to collect contractual cash flows. You bought the bond, which will guarantee you 10% every year, 10% every year. And at the date of redemption, you will be paid your principal. But listen, today when I'm buying it, listen carefully, today when I'm buying it from the stock market, Safaricom issued that bond, or it's East African breweries which issued the bond. As an investor, I bought it. I am timing to see that in case the market price of the bond goes up in the market, I will sell it. I will sell it and make the profit. Listen, it's not that I can't keep it until it matures. No. But my aim of buying it, it's for speculation in nature. Yes, it guarantees me contractual cash flows. That's a guarantee. Before I sell it, I'll be getting my 20 million. In case conditions don't favor me, I'll keep it until it matures. But if conditions favor me in the market, I'll sell it. So one condition we are saying is this, that again, they are held to collect. They are held to collect contractual cash flows. To collect contractual cash flows, listen, and I am adding now that one, and to sell before maturity. And to sell before maturity. So if you look at that one and the one at amortized cost, yes, listen, both of them could be a 10% bond. Yes, they guarantee me contractual cash flows. But for the first one that was being measured at amortized cost, my aim was not to sell. My aim was to keep it until it matures. But this second one, yes, I bought a 10% bond, but my aim is to sell it in case the market favors me. So yes, I am holding it in the meantime to collect contractual cash flows and to sell before maturity. Number two, still under that. Number two, those contractual cash flows, we are saying cash flows are for payment. Cash flows are for payment of interests and principal. Cash flows are for payment of interest and principal. Good. So when you have such an instrument as an investor, which you are holding it, to collect contractual cash flows. 2, I have said, but you are keeping it to sell it before it matures. That's condition number 1. 2, those cash flows are for payment of interest and principals. Then, how do you measure it? By the end of the year, go and get the market value. That's what we are calling fair value. You bought that bond for 10 million or whatever million. What is the market value of the bond in the market? That is the fair value. Whatever is the change in fair value now, take it through OCI. Good. Next. What if you bought, listen now, what if you bought a financial asset, which is an equity instrument? You as an investor B, you bought some shares of company A. You bought some shares of company A. You bought some shares of company A. That's what we want to find out. How do you measure them? How do you measure them by the end of the year? How do you measure those shares at the end of the year? So give me time. I want to do something here. Okay, so let's continue. Okay. Now, so this is quite simple. Listen, this is quite simple. It's an equity instrument. That one, there is no question about it. That means we are saying this is for equity. Let me put it that way. For equity shares, listen, not for trading. You bought shares, listen carefully. You bought those shares not for trading. Meaning, you bought the shares of company A not for speculation. Company A issued shares and you bought them. But you as an investor, you are not buying them for trading, for speculation. No. You are buying them to keep for long term. So if you have such an instrument which has that characteristic to you as an investor, then measure it at fair value initially, subsequently, measure it again at fair value, but the change in fair value, take it through OCI. Take it through OCI. Good. Next. We are going now to the last category. We are now going to the last category, and those are financial assets that should be measured at fair value through P&L. This is, listen now, any other financial asset. Any other financial asset. There are assets you may have, a financial asset you may have, you can't put it under the first category. That is at amortized cost. There are some financial assets you have, you can't measure them at fair value through OCI because they don't meet the characteristic of that. Where do you put such an asset? You measure it at fair value, and the change in fair value, take it through P&L. For example, listen, you bought the shares of company B, no, company A, you are investor B. You bought the shares of company A, but you are buying them. The shares, not the bond, the shares. You are buying them and using them for speculation. The moment the market price of the shares goes up, you sell. So you are not buying those shares with an intention of keeping them for long term. No, you are keeping them for trading, for speculation. That's an example of an asset. You can't put it in the first category under amortized cost. Why? Because it doesn't guarantee you contractual cash flows. You can't put it under category 2 at fair value through OCI. Why? Though it's a debt, though it's an equity instrument, you can't put it under that. Why? Because you are not keeping it for long term. So where else will I put that? It is obvious you put it under other categories. That is through P&L, at fair value through P&L. So this is any other. So we can even say there, e.g. shares for trading, e.g. shares for trading or for speculation. Okay. Now, listen carefully. Listen carefully. I have answered several questions from your past papers. I have answered several theory past paper questions from your past papers. Questions that ask you something like this. State how financial assets should initially be measured and the subsequent measurement of the financial asset or financial instrument. We are not through yet. I've just talked about one part of financial instrument. That's financial asset. I have said financial assets or financial instruments should all be measured at their amortized cost. 2. Subsequent measurement depends on the classification of the financial instrument. We have said in whether they are financial asset or financial liabilities. For financial asset, we have said they can be measured in 3 ways. They can be measured in 3 ways. Good. We have discussed those 3 ways. Good. Now, I can see some people have still joined. Some people have still joined. Just to remind the ones who have joined, just to remind those who have joined that sometimes you may be disconnected because of your Wi-Fi strength. So I have said there are 2 ways you can come back to class if you are disconnected. Just in case before we finish, you get disconnected once in a while. Listen, for those who have just joined us, we have said there are 2 ways of reconnecting back to your class when you are disconnected because of the Wi-Fi strength. 1, you can go and refresh the page. I have said, don't click on the disconnected video. It will not take you back to the class. I have said, click on the link. Click on the refresh button. At the bottom, at the top right, or at the top left, that's where the refresh button is. You refresh the page. That's 1. So 1, you either refresh the page by clicking the refresh button. I was saying the refresh button looks like that. The refresh button, I hope we said it looks like that somewhere, either on the left top or on the right top, depending on the gadget you are using. The second way, if you are disconnected, to go back to class is to go to the link that you received and click it again. And click it again. Don't click on the video. Click on the link again. The link that you received. You go back either to the group or wherever you received it. Click the link again. That's another way. So either you refresh the page or you click on the link. Let's continue. Now, before I put down the summary notes before we put down the summary notes, I have talked about financial asset. Let me talk about financial liabilities. How do we measure financial liabilities? Financial liabilities. In most cases, you are the lender now. A borrower cannot have a financial liability. To them, it's an asset. Now we are looking at it from the point of view of the borrower. he issued a bond. How will he measure that bond? In most cases, financial liabilities should be measured at amortized cost. At amortized cost. We have not discussed how to compute it, but just know they should be measured at amortized cost. But rarely do you find some companies which issue bond in the market, and they are issuing it for speculation. I'm not talking of the investor buying, I'm talking of you, the company, issuing. Rarely will you find companies issuing bonds with the hope that, that bond, the price of it will go down in the market, and then they buy back that bond. It's true they are gaining. But when a company is issuing bonds, normally they are issuing them for financing purposes for long term. But we are saying just in case the financial liability was issued for trading, that means you as company A, you issued a 10% bond at nominal value this much, whatever at price, whichever, but you are waiting to see the price going down in the market. Then you buy back your bond. That way you are gaining. Remember, the investors gave you more. Now when the price goes down and you buy back, you are gaining because you pay them less. In such a case, listen, if they are for trading, listen carefully, if they are for trading, then they should be measured at fair value through P&L. That means the change, you take it through the P&L. Don't forget, I said again, all financial instruments initially should be measured at fair value. So here is a financial liability which you initially measured at fair value, but you issued it for speculation purposes. So again, you will measure it at fair value at the end of the year. But whatever is the change in fair value, take it to the profit and loss. I've said, in most cases, it's rare for companies to issue such bonds. Normally, companies issue bonds with an objective of getting finances for long term. So in such a case, they would measure the bond at fair value initially, but at the end of the year, again, they measure it at its amortized cost. Good. Yes. I want to give the notes now. Ruben, I'm giving the notes. Giving the notes by allowing you to copy this. So put down this. Put down this for my normal students. If others want to put it, it's okay. So put down this: recognition and measurement of financial instruments. 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 Then you say this. Put down this. All financial instruments should initially be measured. All financial instruments should initially be measured at their fair values. All financial instruments should initially be measured at their fair values. Full stop. Continue. Subsequent measurement depends on the classification. Subsequent measurement depends on the classification of the financial instrument. depends on the classification of the financial instrument, i.e., I've said subsequent measurement depends on the classification of the financial instrument, i.e., whether it is a financial asset or a financial liability, i.e., whether it's a financial asset or a financial liability. Another paragraph. Financial assets, sorry, put it this way, the following are the various ways, in which financial assets should be measured. The following are the various ways in which financial assets should be measured. 1. At amortized cost. That's number 1, at amortized cost. Number 2, at fair value through P&A, through OCI. At fair value through other comprehensive income. Number 2, at fair value through other comprehensive income. 3, at fair value through P&L. Number 3, at fair value through P&L. At fair value through P&L. Good. Then, for those 3 categories, I think the best thing to do is just to copy this chart now. It gives you almost everything in a summary form. It gives you everything in a summary form. Copy that section, then I roll it up. I have that financial asset at the top. Then I have broken it down into 3 parts. Just to assist you, I think it's better, instead of putting them in notes, it's good to put them in a chart. It gives you a general overview. You see it clearly. Instead of writing in terms of notes, when we put it in summary chart, you are able to see clearly. So you start with the financial asset, put it there, break it into 3. The first one is at amortized cost. Second one is at fair value through OCI. And then finally, at the end, at fair value through P&L. So have that, then I move the table up. Have that, then I move the table up. Have that, then I move the table up. So once you are through with that, I move the table slightly up. Now we can see at amortized cost. On the left, at amortized cost, I've given you the conditions. Number 1, which kind of financial asset should be measured at amortized cost? Condition 1, those held to collect contractual cash flows. To collect contractual cash flows. 2, cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Good. That is it for the amortized cost. Then, once you are through with that, you come to the second, that is at fair value through OCI. There we have some 2 subcategories. 1 for debt instrument, and number 2 for equity instrument. For debt instrument, that means an asset which is over debt in nature. you bought a 10% bond, fine. Or an equity instrument, you bought the shares of that company. Then I want to roll up again so that you see the conditions. We have said for debt instrument, conditions are: 1, held to collect contractual cash flows. Held to collect contractual cash flows, and that is the word, and to sell before maturity, and to sell before maturity, and to sell before maturity. That's one condition. Number 2, cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Good. So once you know those two conditions, then such an asset should be measured at fair value through OCI. For equity instrument, we have said the condition there, it should be for equity shares, not for trading. For equity shares, not for trading. Those shares that you are holding, not for trading. You can even just say for shares not for trading. I think it would have come out better. Shares not for trading. Good. Once you are through with that, I roll down the question because there is another branch at the extreme right. There is another branch at the extreme right. And that is the one at fair value through OCI, through P&L, sorry. And we have said any other financial, we can even say for any other financial asset, for any other financial assets, e.g. shares for trading, e.g. shares for trading. Good. So finish now. Finish now. I think that in form of a table is better summary than putting it in terms of notes. Remembering them in terms of notes may be not very easy as compared to when you put them down in form of the chart. So finish, I've talked about assets. We want to talk about liabilities now. So finish, we talk about liabilities. Once I've not asked you, by the way, I don't know whether I'm communicating. Is the sound loud and clear in the first place? Is the sound loud and clear in the first place? Sometimes I assume you are following or you are hearing. Kumbe, these technology issues, you are not hearing. Tell me whether you are able to hear loud and clear. I've not asked you today. Are you able to hear loud and clear? Yes. Thank you. Clear. Fine. So finish. We now write something about the liabilities. So finish. We write down something concerning liabilities. Thank you. Okay, ukimaliza, we want to put down something below that for liabilities. So finish, I put down something for liabilities. Okay. So if you are through, put down somewhere below that. Some IV below that table. You say this: financial liabilities. Financial liabilities should be measured. Should be measured at their amortized cost. Financial liabilities should be measured at their amortized cost. Will stop. If they are held for trading, if they are held for trading, if they are held for trading, then they should be measured. They should be measured at their fair values through P&L. If they are held for trading, they should be measured at their fair value through P&L. Call me after this, Karanja. Call me after this. We talk. You have written down something there. We need to talk. Call me after class. You have my number. You have said you want to attend this revision class. So call me after this. We shall talk. I'll give the number after class. You want to attend the special revision class. So we shall talk. I'll mention it. I'll mention it. Okay. So I hope you have written the summary note that financial liability should be measured at amortized cost. Then I've said if they are held for trading, they should be measured at fair value through P&L. They should be measured at fair value through P&L. Good. Sawa. So let's go on. Let's go on now. So let me start with financial liabilities. How to calculate the amortized cost. Let me start with financial liabilities. How do we calculate the amortized cost? Now listen. I want to assume that company A issued a 10% bond whose nominal value was that 200 million. Listen, for them to raise that 200 million, that company decided that they would issue this bond at a discount so that guys will buy the bond quickly. Let's give them a discount. So the company issued the bond at a discount of maybe 10% or 5%. 5% of 200 million is about 10 million. So the company did not receive 200. They must have received 190 if they issued a bond whose nominal value is 200 at a discount of 5%. So they must have received 190. But at the same time, listen, at the same time, this company, in the process of trying to raise this 200 million or to raise these finances, they incurred some costs. Those were what we could call flotation costs or issue costs. Maybe they had to hire some lawyers to prepare prospectus and so on, and all other costs. So assuming there are costs that was incurred, which we can call issue cost. For now, I'm assuming the issue cost was 5 million. So effectively, this company received from the bond, they effectively received 185 million. That 185 million now becomes, listen, now becomes the fair value on initial recognition. I told you all financial assets all financial instruments should initially be measured at their fair values. So whatever is the net proceeds from the issue of your bond, that amount you are considering to be the net proceeds, that becomes the fair value initially. So to get the fair value on initial recognition, get the net proceeds from the issue of the bond. From this illustration, I have taken the nominal was 200 million. These guys decided to issue the bond at a discount of 5%. Then we are assuming they incurred a flotation cost or an issue cost of 5 million. So effectively, the company received 185 million. If the examiner asks you to show the double entry like in some questions, you will debit bank by that 185 million and you credit the 10% bond as a liability. That is it. So now I have done the initial recognition. I have said subsequent measurement. Now, I want to measure this bond at its amortized cost. So to get the amortized cost of this bond, I will be required to prepare the amortization schedule. You prepare the amortization schedule. In that schedule, you know that you have done finance. You always start with the column for the year. You come to balance brought down. You come to what we call finance cost. You come to what we call cash paid. And you come to what we call balance carried down. So you start with the first day of the year. The balance brought down is 185 million. That was the fair value initially. Then you get the interest charge. Don't forget, it's a liability. So what is it that you are being charged as interest? Listen, to get the interest charge to go to the P&L account, which is what we are calling the finance cost, you don't use the 10%. 10% is what you normally call the coupon rate for this bond. But to get the finance cost or the interest charge for the year, listen, we normally use the effective interest rate for the bond, the effective interest rate in the market. The question might tell you that the effective interest rate was 12%. Let me assume. So you take 12% of 185 million. 12% of 185 million, what does it come to? I am assuming 12% of 185 million, I am getting something like 22.2. For purpose of illustration, let me just assume 22. Then, listen, I told you, as a company, every year you must be paying interest. 10% of 20 million, 10% of 200 million, 10% of 200 million. So every year, you as a borrower, you are paying your investors 20 million. Then they are receiving, you are paying. Good. So every year you are paying 20 million. Listen, that 20 million, I am not paying anything to do with the principal amount. No. That 20 million is what we call the cash interest payment, not the principal. I'm not paying anything for the principal. Don't forget, this bond will be redeemed after 5 years. And it is at the 5th year that you will pay back the 200 million. So before that time, what you're only doing is to pay the cash interest. You are not paying anything of the principal. No. You're only servicing the cash interest. Good. Then you calculate the balance carried down. Which is 185 plus 22, the interest being charged, minus what you are paying at the end of the year for cash interest. That looks like 22 minus 20, that's 2. 2 being a positive, I add to 187, that comes to, I add to 185, it comes to 187. That 187 is the amortized cost at the end of year 1. Then I repeat the process for year 2. I come and say year 187. Again, I take 12% of that one. Let me assume, for purpose of illustration, that the amount is 23. Then I pay again in that second year 20 million. Don't forget that 20 million is the cash interest payment on the 10%. 10% is what we call the coupon rate. So we use the coupon rate to calculate the cash interest payment. We use the effective interest rate to calculate the interest charge for the year. I hope you are following. Then from there, now get the balance come the end of the year. 23 minus 20 is 3. I add it to 187. That looks like exactly 119. Good. I come to year 3. That is 119. I charge 12% of it again. For purpose of illustration, let me assume 24. Then again, I pay 20 million. Then I get the balance carried down. Okay, then I carry down the balance. And the balance is 24 minus 20, that is 4. 4 plus 190, that is 194. Then I go to the 4th year. I bring down the liability, 194. I take 12% for purpose of illustration. Let me assume it is 25. I pay 20. I get the carry down. By the end of the year, what is the carry down? 25 being a positive, 20 being a negative. I am left with a positive 5. Positive 5 plus 194, that comes to 199. That comes to 199. I come to the final year, that is 199. Then again, I charge 12% for purpose of illustration. Let me assume that it is 26 for purpose of illustration. Then I pay the normal interest for that year. Listen again. It is in this year that we are redeeming that bond. It is in this year that we are redeeming the bond. So you go back to the question and ask yourself, are you redeeming this bond at par? Are you redeeming the bond at a premium, or are you redeeming the bond at a discount? Because it can either be either way. So you go back and check from the question, how are we redeeming this bond in the 5th year? If the examiner tells you you are redeeming the bond at par, then you pay again the exact 200 million. So on top of the 20 that you paid for interest that final year, you pay another 200. If the question tells you you are redeeming them at a premium, let us assume the question tells you you are redeeming this bond at a premium of maybe 2.5%. Meaning you pay more than the 200 on redemption. So if I'm redeeming at a premium of 2.5%, 2.5% of 200 million is, we saw 5% as 10. Now, good. We saw 5% as 10, so 2.5 must be 5. Good. So if I'm redeeming it at a premium of 2.5%, that means I'm adding an extra 5 million. So that year, I pay another final payment of 205, and that will be all. There should be no liability. So if I take 199 plus 26, I minus 20, I minus 205, there should be no balance. There should be no balance. Good. So now you have done the amortization table now. Then now take the figures concerned either to the income statement or to the balance sheet now. Either to the income statement or to the balance sheet. Because the question might tell you to prepare profit and loss extracts for each year and balance sheet extracts for each year. So if they tell you to do that, let's see how it will affect your income statement. So In your P&L account, in your profit and loss extracts, you will need a column for the year. You will need a column of the interest, or what we are calling finance cost. Year 1, year 2, year 3, year 4, year 5. Year 1, you remember, I charge interest of how much? 22. Unaweka 22. Second year, I charge 23. You remember? Third year, 24. Fourth year, I remember 25. And finally, I charge 26. So that's all as far as income statement will be concerned. If they tell you to prepare profit and loss extracts, good. Now we do balance sheet extracts now. We now prepare our balance sheet extracts. Balance sheet extracts. How will it appear? Among your non-current liabilities, this is year 1, year 2, year 3, year 4, year 5. Among your non-current liabilities, there you will have a 10% bond. Somewhere along the current liabilities again, somewhere you will have a 10% bond. Let's argue. By end of year 1, according to the table, we carry down an amortized cost of 187. Listen, we carry down an amortized cost of 187. Remember, this bond will be redeemed in the 5th year. So it means that 187 will be paid in the 5th year. There is nothing I am paying of the 187 or the 200. What I was only paying, I was servicing the interest. I was not servicing the principal. No. So everything of the principal will be paid in the 5th year. Now listen. So if by end of year 1, according to this table, I am carrying down a liability of 187, it automatically tells me that as a company, I have another 4 more years to go for me to pay it. I have the 2nd year, 3rd year, the 4th year, and the 5th year to pay what? To pay that 187. And because it will take me more than a year to pay it, then in the balance sheet of year 1, I take it as a long-term liability. So in the balance sheet of year 1, I take that 187 as long-term, meaning there is no current component, no. 2nd year, I go back to the table, I can see we are carrying down 190. That 190 will be paid in the 5th year. That's when it will be redeemed. So I have another 3 more years to go. I have the 3rd year, the 4th year, and the 5th year. Those are 3 more years to go. So that 190, being that it will take me more than a year to pay it, then I classify it as long-term. 2nd year, I classify that 190 as long-term, nothing current. Good. 3rd year, I am carrying down 194. I will take another 2 more years to go for me to pay that 194. I am at the 3rd year MQ, so I still have the 4th year and the 5th year. So that 194 will take me more than a year to pay. That's another long term. So in the balance sheet of year 3, that 194 is long term. Put it 194, nothing current. In the 4th year now, watch, in the 4th year, we are carrying down 199. That 199 must be paid within the next 1 year. In other words, we are saying, come the following year, we shall owe nobody anything. We shall owe nobody anything. We shall have cleared it. So that 199, because it has only 1 more year to go, then in the balance sheet of the 4th year, you don't take it as a long-term liability, you take it as a current liability. You have less than a year to go to pay that 199. So in the balance sheet of year 4, take that 199 not as a long-term, but as a current, that 199. Of course, in the 5th year, there is no liability, therefore no long-term. no current. No long-term, no current. Good. So I have done a simple illustration on how to determine what we are calling the amortized cost of a financial liability. Good. So let's put down an illustration for that now officially as part of your notes now. Let's put it down officially as part of your notes now. So put down this example. Before we do a past paper question, put down this example now. Andika example. Sema hivi. ABC Limited issued shillings 20 million, 4% bond. ABC Limited issued shillings 20 million, 4% bond. Full stop. The bond was issued. The bond, continue, was issued on 1st January 2015. On 1st January 2015. On 1st January 2015. Full stop. Continue. The bond was issued at a discount. Issued at a discount of 2.5%. The bond was issued at a discount of 2.5%, and the issue costs amounted to shillings 534,000. And the issue costs amounted to 574,000. Full stop. The bond will be redeemed. The bond will be redeemed after 5 years. The bond will be redeemed after 5 years at a premium of 10%. The bond will be redeemed after 5 years at a premium of 10%. Full stop. The effective interest rates, continue, the effective interest rates is 7%. The effective interest rate is 7%. The effective interest rate is 7%. The effective interest rate is 7%. Required. Required. Number A. Required. Number A. Calculate the amount. Calculate the amount to be recorded. Calculate the amount to be recorded as a financial liability. Calculate the amount to be recorded as a financial liability when the bond was issued. Calculate the amount to be recorded as a financial liability when the bond was issued. Number 2, or B. Number B. prepare profit and loss extracts and balance sheet extracts for each year. Prepare profit and loss extracts and balance sheet extracts for each year. Good. That is all. We want to do that illustration before we do a past paper question now. So number 8 obviously asks you to determine the fair value. That's all. On initial recognition, I told you the initial fair value is what we call the net proceeds. The net proceeds from the issue, that's what you consider to be the fair value. So andika somewhere, number A, determination, put it down, determination of the fair value, determination of the fair value on initial recognition. Determination of the fair value on initial recognition. Determination of the fair value on initial recognition. Good. So let's determine the fair value. I told you to just take the net proceeds. So come and say your nominal value. Nominal value, we were told, was 20 million. We issued a 10%, no, a 4%, 20 million bond. Good. That is the nominal. Then we less the discount. We were told we issued it at a discount of 2.5%. That is 2.5%. We issued it at a discount of 2.5%. 2.5% of 20 million is how much? 5% will be a million. That means automatically 2.5% must be 500,000. We minus 500. Then don't forget we have those issue costs. And we have been told the issue cost amounted to 534,000. So that leaves me with what we are calling the fair value, which is the same as net proceeds. Net proceeds, how much? So let me take that 20 million. I minus 500,000. I minus 534,000. I am left with a balance of 18,966,000. 18,966,000. Good. That is the net proceeds. I told you, if the examiner wants you to show the double entry for it, just debit bank 18,966,000. 18,966,000. Then you credit the 4% bond. 18,966,000. Good. So that's part A of the question. That is part A of the question. We cannot do part B without first preparing the amortization schedule. So let's prepare the schedule now to get the amortized cost at the end of each year now. So let's have those columns. We need a column for the year. We need a column of the balance brought down. We need a column of the finance cost. We need a column of the cash paid. And we need a column of the balance carried down. Good. Because of the long figures, I believe we can put down the figures in thousands. That's 2015. That's when the bond was issued. I think so. Let me confirm. Yes. So it is 2015, 2016, 2017, 2018, 2019. So it is 18,966. Because of the table of the long amount, let me make it 18,966. In other words, I'm putting the amount in thousands, no problem. I'm putting the amount in thousands, no problem. Then I take the finance cost. I've said it is at 7%. We were told the effective interest rate was 7%. So I take 7%, 18,966 times 7%. That gives me, to the nearest whole number, it is giving me 1328. 1328 to the nearest whole number. Just confirm. Then we pay the interest at what rate? 4%. 4% of what? Of the nominal. 4% of what? The nominal. Don't forget. Interest we calculate on the balance. Cash paid we calculate on the nominal. Our nominal was 20 million. 4% of 20 million looks like 800,000. 4% of 20 million looks like 800,000. You minus 800. So our figures are in thousands, so we put it that way. So I take that 18,966. I add 1328. I minus 800. So by end of year one, I am carrying down a liability of 19,494. If I'm correct. If I am correct, that's what I'm carrying down. We bring it down by the beginning of year two. We bring it down by the beginning of year two. That is again 19,494. Charge 7% of it. I get an amount of 1365 to the nearest whole number. 1365. Again, I pay 800. Then I get the carry down. We are taking 19,494 plus 1365 minus 800. I am carrying down 20,059. 20,059. Good. We come to the third year, 20,059. I charge 7% of it. That looks like 1,404 to the nearest thousands. Again, I pay 800, which is 4% of the nominal. Then I get the carry down. That is 20,059 plus 1404 minus 800. That leaves me with a balance of 20,663. If I'm right. Good. We go on to the fourth year. I bring down that 20,663. I charge 7%, sorry. 7% of it. That looks like 1446. If I'm right, be confirming my figures, by the way. We pay 800 that year. Then we get the carry down. That is 20,663 plus 1446 minus 800. That gives me 21,309. 21,309. We come to the final year. 21,309. I charge 7%. That comes to 1492 to the nearest whole number. I pay 800, but again, don't forget, this is the year we are redeeming. This is the year we are redeeming. So you go back to the question and ask yourself, how are you redeeming the bond? Are you redeeming it at par? Are you redeeming it at a premium? Or are you redeeming it at a discount? I think the question told us that we are redeeming it at a premium. Yes, I can see it here. We were told that we are redeeming it at a premium of 10%. The nominal value was 20 million. So if I'm redeeming it at a premium of 10%, 10% of 20 million is an extra 2 million. And so in the final year, we are paying a total of 22 million. The nominal is 20, the premium is 2 million, so we are paying a total of 22 million on redemption. On redemption. So that's what I'm paying. That is 22 million. Good. Of course, there should be no balance. You may find some questions, the balance is slightly small, but it should not be there. It should not be there. For example, like this one, 21,309 plus 1492. I get 22,801. But when I add the payments, it's coming to 22,800. There is a slight difference, but that's acceptable. That is acceptable. So we can now prepare the balance sheet extracts and the P&L extracts now. So let's show how the two financial statements are affected now. So one of them we have agreed is the profit and loss extracts. We need a column for the year, a column of the finance cost. That is 2015, 2016, 2017, 2018, and 2019. We just pick the charges according to the amortization table. First year we are charging 1328. Put it. That is 1328. Next one, we are charging 1365. That is year 2. 1365. Year 3, what are we charging? We are charging 1404. Year 4, we are charging 1446. 1446. And finally, in the 5th year, we are charging 1492. Good. 1492. Good. So finish. That's all for that. We want now to go to the balance sheet extracts. So let's do the balance sheet extracts for the 5 years. That is year 1, year 2, year 3, year 4, and year 5. I've told you that among the non-current liabilities, there you will have a 4% bond. A 4% bond. Then somewhere again along the current liabilities again, somewhere along the current liabilities, you will have a liability called 4% bond. Good. So we go to the amortization schedule. What are we carrying down? By end of year 1, I am carrying down a liability of 494. Remember, we have agreed everything will be redeemed after 5 years. So for that 494, you still have 4 more years to go. That is the 2nd, 3rd, the 4th, and the 5th. 4 more years to go. That's more than a year. Take it as long term. Put it 494. That's long term. 494. Nothing current that year. Put a dash. Nothing current. We go to year 2 now. On our 2nd year, what were we carrying down? We were carrying down a liability of 20,059. That again has 3 more years to go. I have the 3rd year, 4th year, and the 5th more year. Those are more than 1 year. That is long term. That 20,059 is long term. 20,059 in year 2 is long term. Put a dash in the 2nd year among the current. Nothing. 3rd year, what are we carrying down? We are carrying down 20,663. That again, I still have 2 more years to go. How we got 22? Somebody is asking, how did we get 22? We got it by saying, remember the question told us we are redeeming the bond at a premium. Somewhere the question told us, I have circled it even in red. Up there, we were told by the question that the bond will be redeemed after 5 years at a premium of 10%. Don't forget the bond had a nominal value up there of 20 million. So if the nominal is 20 million and we are redeeming it at a premium of 10%, 10% of 20 million is 2 million. That is the premium. So your premium on redemption will be 2 million, but you don't just pay the premium, you pay plus the principal. And that's what we are saying. Our principal is 20 million plus the 2 million premium. That automatically means in total, you are paying 22 million. I hope, Mary, now you have understood how we are paying it. If the question, I told you, if the question had said we are paying or we are redeeming at par, then I would have just paid 20 million. But now our question said we are redeeming at a premium. That means more than the par value. The par value is 20, premium of 10% of that. That is it. Thank you, Mary. Sawa. We move on. So let's go now to the balance sheet of year 3. I think that's where we were. Yes. So we go to the table. What is our liability by end of year 3? Our liability by end of year 3 is 20,663. Again, I have 2 more years. The 4th and the 5th. That's more than a year. So take that 20,663 as long term. That is 20,663. Put a dash among the current. That is 3rd year. We go back, 4th year. What am I carrying down? I am carrying down 21,309. By the following year, which is next year, it will not be there. So in the next 1 year, that 21,309 will have been cleared. So we don't consider it as long term, we consider it as current. I have just less than a year to go. So that is current. That is 21,309. So there is nothing long term in the 4th year, but there is current 21,309. Finally, in the 5th year, no long term, no current. Good. So finish. We are through with it. So that was just a simple illustration on how to compute what we are calling the amortized cost. But it's not a simple one, because I think I have seen a past paper question which was almost similar, but the examiner tried to changanya you. I think we shall do the question. It is almost similar, but they wanted you to reorganize the information, Who is that? Susan. I have not said if it is paid at a discount. Okay, fine. Let us assume. Yeah, fine. Okay. Look at it this way, Susan. It had a nominal value of 20 million. Suppose the question tells you are redeeming it at a discount of 10%. Discount. So you will not pay 20. You will pay how much? It is obvious you're going to pay less by 10%. 10% of 20 is 2 million. So you will pay 18 million. That's the amount you're going to pay at a discount. If you are redeeming at a discount, then you pay less. If you are redeeming at par, you pay 20. We saw if you are redeeming at a premium of 10%, you pay 22. That extra 2 million is the premium. If you are redeeming at a discount of 10%, that 2 million is the discount. So you pay 18. Mary, are you okay now? Why is the 21 current? It is current because if you go to my table, the amortization table, here it is. I hope you are seeing it up there on the right. That is our liability by end of year 4. And you can see in the next 1 year, there will be no liability. It's a dash. So everything is being redeemed in the 5th year. So if by end of year 4, I have a liability of 21,309, it means in the next 1 year, I must clear it. So there is no way it will take me more than a year to pay that 21. It will take me less than a year to pay it. Okay? It will take me less than a year to pay it. So, and therefore, as at 3rd, 4th year's balance sheet, I don't take it as long term, I take it as current. Are you okay, Rebecca, now? Are you okay, Rebecca? Why we are taking it as current? Because it must be paid within the next 1 year. It must be paid within the next 1 year. No. It cannot be more than the nominal. Ukiambiwa ununue bonds za Safaricom at more than the par value, they will not issue at more than the par value. These are not shares. These are bonds. Normally they are issued at a discount or at par. But shares can be issued at a premium. That's okay. But bonds, normally at a discount or at most at par. Because there is even a flotation cost. Okay? Yes. We shall have. Yeah, it cannot be more than the nominal. That one you have answered. So we have no time to do the past paper question I wanted us to do. So for my normal students, we do the past paper on Wednesday. You know that. We have a class on Wednesday. So we do that on Wednesday now. We do that on Wednesday for my normal class. Okay. Now, for any new students who is here, listen, for any new student who is here and would wish to continue with us, listen, for any new student who is here and would want to continue with us, you can call me on the number 0722 658875. Listen, either you want to continue as a normal student in the normal class or as a student in the special revision. We have another stream for special revision class, only revision, pure question and answers, pure question and answers. We just do that. This is for people who have already been taught before. They only want to do practice. That is for revision class. Okay? But if you have not been taught before, or you feel you need the information afresh, then you go to the normal class. Okay? So if you go to the normal class, we have early morning classes and we have evening classes. You can choose either. If you are going for the normal class, you either choose the early morning or the evening class. Whichever the case, if it's early morning, we normally meet every day. We normally meet on Monday, Wednesday, and Friday. We normally meet early morning on Monday, Wednesday, and Friday from 5:30 in the morning to 7 in the morning. That is if you choose early morning. If you choose evening class, we meet every Monday, Wednesday, and Saturday at 8 p.m. to 10 p.m. Good. If you choose evening, then the charges are 4,000. The charges are 4,000. We shall also give you the videos of the classes you have already missed. We shall also give you the videos of the classes you have already missed for those who are joining, who would want to join. For special revision, the charges are 3,000. The charges are 3,000. So there was somebody who wanted to join the special revision. There is somebody who wanted to join special revision. Somebody has asked whether we shall start block release. Yes, we shall have another stream for block release. There are some people who are already waiting for block release. That one we shall form it. Maybe early next week. Maybe early next week. You will see the communication. So if you are for blocks, calling me by end of this week, I will have decided which date and which whatever for block release. Good. Because we normally have another stream for those who want to do block release again. So because of time, we can't do another question. We can stop there. So this is for information for the new students. This is information for the new students. I don't know whether at least they have benefited. I hope they have benefited from the today's free class. I hope they have benefited. Maybe there is one who has joined us for that free class and maybe he would want to comment. I don't know. But I hope the new students who have joined us for the free class, we hope they have understood something. They have understood something. That's what we want to say. Good. And for those new students, if you want to join, call me on this. You either join the normal class or you join the special revision class. For the normal class, it's either early morning or evening classes. Good. Okay, because of time, I don't have time to start something new, so let me wish you a good night. For my normal students, let's meet on Wednesday, where we now continue and do the past paper question, and then I develop the topic. Okay. So we have no time to do the past paper question I wanted us to do, but we shall do it on Wednesday. Good. Okay. You have told me the sound was loud and clear. Yes. Good night. Was there anybody who got disconnected today? Was there anybody who got disconnected? Yes, there could be, because maybe some new students did not know how to come back. But I've just told you, listen, I've told you the moment you are disconnected, you either refresh the page using the refresh button, either at the top left or at the top right of the page, or you go back and click on the link again. Don't click on the video. It will not refresh. But you click on the refresh button, it will refresh the page. You come back to class immediately. Or you go back and click on the link that you have received again. Good. Have a good night. Okay. So see you. We are hoping that the new students have enjoyed the class. That's what I'm hoping, that any new students has enjoyed the class. Good. See you then. Okay. Good night.